Hi, welcome to the Crypto Republic. Before we begin today, if you're serious about staying ahead in this once-in-a-lifetime financial shift, make sure you like this video, drop a comment, and subscribe to the Crypto Republic. Hello, XRP Army, and welcome back to the Crypto Republic, your go-to channel for the latest energy updates and digital assets. Before we get started with today's business, make sure to smash that like button, ring that bell, and subscribe to Crypto Republic, bringing you updates every day at 9 a.m., noon, and 7 p.m. Eastern Standard Time. Here at the Crypto Republic, we give you the bird's eye view, a satellite perspective to spot the big picture shifts while everyone else is stuck in the daily chaos. Just a reminder, this video is for educational purposes only. This is not financial advice. Always do your own research before making any investment decisions. Well, ladies and gentlemen, today we're going to discuss something that might make some XRP holders uncomfortable. Most people who own XRP don't actually understand what they're holding. And I don't mean they can't explain it. They can tell you it's fast. They can tell you it's cheap. They can tell you it settles in seconds. They can even tell you it's used for cross-border payments. But if you stop them and ask one simple question, why does this asset need to exist at all? That's when the answers start to fall apart. And that's important, because when you misunderstand the process of something and purpose of something, you end up measuring it with the wrong yardstick. You expect it to behave like something it was never designed to be. And history is full of people who misunderstood infrastructure in its early stages. When the internet was first rolling out in the early 90s, most people thought it was just email and chat rooms. They didn't understand that they were looking at the foundation for global commerce. When the interstate highway system was proposed in the 90s, critics argued it was overbuilt and unnecessary. They didn't realize they were looking at the backbone of modern supply chains. Infrastructure always looks excessive until it's essential. That's why the price action frustrates people. That's why debate goes in circles. That's why everyone sounds confident, but nobody sounds complete. And here's something else most people don't like to think about. Understanding this asset properly requires thinking about scenarios most people would rather ignore. So in this video, we're going to slow down. We're going to strip away the noise, and we're going to talk about what XRP was actually built for, not the version retail investors imagine. Not the version critics attack, but the structural reason it exists. And once you see that clearly, you might look at this asset very differently. But before we go any further, this is not financial advice. This is educational content meant to help you think more critically about markets and positioning. Now let's dissect this. The real misunderstanding when people argue about XRP, they're usually not disagreeing about facts. They're disagreeing about frameworks. Some view XRP as a speculative crypto play. Some view it as a payment token. Others see it as a financial infrastructure. And those three perspectives lead to three different completely expectations, even when everyone is looking at the same exact chart. That's why conversations feel repetitive, because they're not debating data. They're debating lenses. It's like three people looking at the same building blueprint. One is asking how tall it is. One is asking how profitable it is. One is asking if the foundation will hold under stress. Only one of those questions determines whether the building survives an earthquake. It is core. XRP was designed as a neutral settlement bridge. That word neutral matters. Neutral means it does not belong to one country. It does not sit inside one banking system. It does not require political alignment. And neutrality becomes powerful when trust weakens. Retail versus institutional thinking. Here's the contrast most people never articulate. Retail thinks in price targets. Institutions think in settlement certainty. Retail asks, how high can this go? Institutions ask, will this clear when counterparties are stressed? Retail celebrates volatility. Institutions fear settlement delays. And history shows us this difference clearly. During the 2008 financial crisis, everyday investors were watching stock prices drop. Meanwhile, institutions were scrambling because overnight lending markets froze. It wasn't price that caused panic. It was settlement risk. Lehman Brothers didn't collapse because the stock chart looked ugly. It collapsed because counterparties stopped trusting settlement. That's the layer infrastructure lives on, ladies and gentlemen. What most people never think about. Let me tell you a quick story. In 1974, a small German bank called Bankers Herstatt collapsed during currency trades. Due to time zone differences, one side of the trade had already paid Deutschmarks, but the US dollar side never arrived because the bank failed before settlement. That event became known as the Herstatt risk. It exposed something simple but terrifying. Settlement timing matters more than price. That single collapse changed how global FX markets operate, not because of speculation, because of settlement mechanics. Global finance is built on obligations, and those obligations must clear even when trust disappears. That's the environment XRP was built for. Not calm, not comfort, stress. The "it can stay cheap" argument, ladies and gentlemen. I want to talk about this. Now let's address something you've probably heard. XRP doesn't need to be expensive because it can be reused. Under calm conditions, that logic sounds reasonable, but calm conditions are deceptive. Let me give you an analogy. Imagine a city that rents generators during storms instead of owning emergency power stations. When storms are rare, that system works. But when a hurricane hits and everyone needs generators at once, rentals disappear instantly. Suddenly, ownership matters. That's the difference between convenience, liquidity, and secured liquidity. XRP wasn't engineered just for sunny days. It was engineered for the storm. And this is the part most people won't like. And if you made it to this point, ladies and gentlemen, I appreciate a like. And if you're new here, please subscribe so you can keep up with us with all the breaking news that we go over every day and my rant at the end that everyone's come to love. Because now we have to talk about what happens when calm disappears. When liquidity changes behavior, take crypto out of the equation. Imagine you're running a business. You're profitable on paper. Your bank limits withdrawals. Credit tightens. Suppliers demand upfront payment. You're still valuable, but access is restricted. That's the liquidity event. In 2008, banks didn't suddenly forget how to make money. They stopped trusting each other overnight. The interbank lending market froze. And when trust froze, liquidity froze. It wasn't about valuation. It was about timing. And here's what history repeatedly shows us. Under stress, liquidity doesn't vanish. It retreats. Institutions protect balance sheets. Counterparties demand collateral. Capital becomes selective. That's human behavior. And infrastructure is designed around human behavior, not optimism. Price, scale, and compression. Now let's talk about scale. When the U.S. moved off the gold standard in 1971, global settlement dynamics changed dramatically. Suddenly, currencies were no longer backed by a fixed physical anchor. Trust became policy-based. That shift didn't show up in one dramatic candle on a chart. It reshaped decades of monetary architecture. Infrastructure changes don't spike. They reposition. Here's the practical reality. If an asset is priced extremely low, massive quantities are required to move large sums. At institutional levels, that creates friction. High-priced isn't hype. It's compression efficiency. Moving 10 billion through a system using fewer units reduces operational complexity under stress. So here's the asymmetry clearly stated. If nothing breaks, XRP stays quiet. If something breaks, quiet infrastructure doesn't stay quiet. It won't move because of hype. It would move because settlement required it. That's a structural trigger, not a retail one. I want to talk about the psychological gap. Here's the micro story most holders live through. You buy, you wait. Nothing dramatic happens. Other assets pump, you question your thesis. You wonder if you missed something. That emotional cycle is common in early infrastructure plays. Railroad investors in the 1800s endured long periods of stagnation before expansion reshaped America. Telecom investors in the early internet era endured volatility before bandwidth demanded exploded. Infrastructure rewards patience, but it tests conviction. I want to talk about what this asset could become. So let's bring it back. What could this asset become? It could remain exactly what critics say, underutilized, or it could function as a neutral bridge during structural shifts in global settlement behavior. History doesn't give guarantees, but it gives patterns, and one pattern is clear. When systems strain, assets built for strain become visible. You don't need hype. You need understanding. You don't need certainty. You need disciplined positioning. Because wealth is not built by reacting to every candle. It's built by identifying structural asymmetry before consensus sees it. This is not financial advice, just my opinion. Don't just hold assets. Understand infrastructure. Don't just chase narratives. Study systems. Because clarity compounds, position with intention. Think in decades, not days. And remember, the loudest assets aren't always the most important. Sometimes the most important ones are the quietest. Well, ladies and gentlemen, it's good to be back. A lot happened. Hope everyone's having a great Sunday. I want to talk about real fast the Middle East escalation and the impending energy situation. None of this is financial advice. I want to welcome all the new members of our Patreon, all the new members of our membership channel. It's fantastic to chat with you and see with everybody. Again, if you're new here, please do subscribe to the channel so you can stay along with all the things that we go over every day when we make these videos. Well, ladies and gentlemen, there's a severe geopolitical dislocation that's going to fundamentally alter energy markets and global macro dynamics. And this is going to unfold in the days ahead. And at the filming of this Sunday afternoon, we're waiting for the open. Well, over the weekend, coordinated U.S. and Israeli military strikes on Iranian targets have effectively triggered a new open conflict in the Middle East. The immediate market response has been aggressive. Based on over-the-counter indications on Sunday, Brent crude has already spiked roughly 10%, pricing near $80 per barrel. However, again, not financial advice, our opinion if anyone retains any capacity. From a fundamental standpoint, the military kinetic action is secondary. As an allocator of thought, an allocator of what you think, right? And this is what I like to tell anyone that retains any capacity. I want you to focus on the physical supply shock currently unfolding at the Strait of Hormuz. Okay, that's very, very important. A lot of ships are waiting there right now to get more supplemental insurance before going through. Again, very, very important. None of this is financial advice. I'm trying to bring it to you as we've been talking to people nonstop over the phones, what's happening around the clock. So following direct warnings from Tehran to commercial shipping, we're witnessing a complete paralysis of maritime logistics in the region. So major energy producers, global trading houses, and tanker operators have suspended all movements of crude oil, refined fuels, liquefied natural gas, LNG through the strait right now. So to quantify that magnitude of this disruption, the signal geographic choke point is responsible for the transit of more than 20% of the world's daily oil supply. This is very, very important. So if we take a fundamental supply deficit and infrastructure constraints, it's rough. Again, this is not advice. This is my professional opinion, and anyone retains this in any capacity. None of this is financial advice, ladies and gentlemen. Our analysis of the physical market indicates that this is not a shortfall that can be easily circumvented, ladies and gentlemen. While there's alternative pipeline infrastructure, specifically the East-West pipeline in Saudi Arabia and the onshore networks in Abu Dhabi, their combined spare capacity is highly inadequate. Even if we're assuming maximum rerouting efficiency through these alternative channels, a total closure of the strait results in a net structural deficit of 8 million to 10 million barrels per day of crude. That's massive. Don't expect the cartel to bail out the market. The OPEC Plus coalition concluded a meeting this weekend agreeing to a production hike of just 206,000 BPDs beginning in April. To put that in perspective, ladies and gentlemen, this increase represents less than 0.2% of global daily demand. So when it rains, it pours. It's a rounding error compared to the impending 8 to 10 million BPD supply vacuum. You got to let that sink in. That's massive. I don't even know what, I'll have to write this down. I don't even know what the rates are for the supply supplemental insurance they're trying to get right now to go through that. That's got to be huge. So winding this back and drilling down, predictably, the panic is already spreading to the demand side. We're tracking rapid policy shifts across the Asian markets where state governments and heavy industrial refiners are urgently auditing their strategic petroleum reserves and scrambling to secure non-Middle Eastern supply lines. Again, that's another reason why we have not had to come out with any videos. We're living on the phones right now because people need physical stuff, not financial advice. Being a financial mercenary, and welcome to our newest financial mercenary, I'm not going to say your name. It's a 24-hour, 7-day-a-week job. And when the conflict hits front lines, because we are in the front lines, this is what happens. People scramble for things, right? We are always positioning, taking advantage of the chaos, being the remora. But again, I want to get back to this because this is massive. This is what's happening. So if you look at the price outlook and what we're looking at from portfolio positioning, none of this is financial advice. Again, not financial advice, just our opinion. Anyone retains as any capacity. As we look ahead to the regular trading sessions, we anticipate a violent repricing event. Violent. We're talking vicious. People going to get cut up like sushi, blood in the waters. Violent. Our internal models suggest an immediate gap up of roughly $20, placing open bids in the low $90. Again, not financial advice. This is just our opinion in any form of capacity that anyone retains. It's not financial advice whatsoever. More importantly, if this maritime blockade is sustained, the fundamentals dictate a clear trajectory towards $100 per barrel. In the event of a prolonged outage, we fully expect crude to breach and sustain levels well above that psychological threshold. None of this is financial advice. Again, remember, this is now when we take advantage of the chorus of chaos and the soap opera of chaos, when we go out to harvest what we've planted, remember, we've been long ourselves, anyone retains any capacity, since the first aircraft carrier group got there. We were waiting for this. Oil tankers are slowing or avoiding transit through the Strait of Hormuz. Again, I'm going to drill down. I want you to remember this. After U.S. and Israeli strikes on Iran, with ship owners reassessing risk exposure along the corridor that carries 20% of global seaborne oil and LNG flows. Ladies and gentlemen, that alone, supply shocks. Again, very, very important. They're trying to get supplemental insurance. I don't even know what those rates look like right now. But moving right along, again, being financial mercenaries, we wait for events like this to happen. And we were waiting for this one. So it's time to harvest the alpha. It's time to harvest the alpha. If you're new here, I'd appreciate a like, and please do subscribe to the channel so you can keep up with the current events that we go over every day. And we're going to move along right now to gold. Bullion braces for historic Sunday gap up as Middle East erupts. Ladies and gentlemen, precious metals markets are bracing for a violent upside shock all at the Sunday evening futures open. We're talking vicious and violent, triggered by an unprecedented military escalation in the Middle East following joint military strikes by the United States and Israel against Iranian targets. A massive wave of panic buying is expected to flood into safe haven assets. Again, being the remora, you don't get cut up like sushi. You got to get that Gucci clarity right here. And why? This is not something that you FOMO when you run into right now. None of this is financial advice. It's my professional opinion, and it retains any capacity. Again, the crisis deepened over the weekend as Tehran executed a sweeping retaliation. Iranian forces have choked off the Strait of Hormuz, a critical maritime choke point responsible for transit of substantial global natural gas supplies and roughly 20% of the world's oil. I'm harping and repeating this because this is a theme I want you to remember. Further exacerbating the panic, the conflict has rapidly spilled across the borders. Iran launching strikes on a staggering list of neighboring territories, including Saudi Arabia, the Kingdom, UAE, Qatar, Bahrain, Kuwait, Iraq, Syria, Jordan. Even before the weekend's hostilities, the Yellow Metal was enjoying robust momentum. Bullion settled Friday at a 4-week peak at 5,279, driven by defensive positioning as traders braced for an immediate military clash. However, geopolitics is only part of the equation. Markets were already digesting a toxic macro environment cocktail of aggressive American trade maneuvers and stubbornly high inflation metrics. With an energy crisis now virtually guaranteed by the Strait of Hormuz blockade, inflation fears will likely compound the flight to safety. As trading resumes, gold is on a clear collision course to test, potentially shatter its historic January ceiling of 5,500. Ladies and gentlemen, if you look at the charts, when we told you when we had sold in, and in that video, I don't know the title of it, that we thought gold would drop the last time it was here, the entire region between 5,000 and where we're at right now, all the positions have been knocked out and structurally changed, okay? So it's clear for takeoff, in my opinion, anyone retains any capacity. It's not financial advice. So now, how big of an overreaction will this be, right? Again, who will know? But the proper positioning before the event is most important. Again, that is what we stress and preach, and that's what we're going over mostly in the Patreon. Again, if you want to understand how you convert things like this, please do join us in the Patreon. I think that the world right now, again, is going into regionalism. Again, regionalism, geopolitical and geoeconomic regionalism will set the theme of the day. That's what I believe. And with all this happening, you can see it. We're going to make a video over certain topics for the Patreon, more in detail. Compliance won't let me do it for YouTube because of what we can and can't say, unfortunate, right? But I want to go into something because this is something that we're telling people that retain any capacity right now. It's most important. We're beginning to position for a select commodity supercycle, ladies and gentlemen, not financial advice whatsoever. We are selectively bullish on certain commodities: copper, aluminum, precious metals, battery raw materials. To us, these stand out again. You understand me? So a commodity rally is underway and tailwind for equities. Okay. So we're watching all of this and we're assessing what's most exposed. Okay. So what are our preferred commodities? We prefer commodities that have secular demand drivers with structural constrained supply side capacity. Again, copper, aluminum, precious metals, and battery raw materials to us stand out. We're looking at this again. We believe this commodity cycle is anchored in 4 durable pillars: the AI and data centers, electric vehicle demand, energy storage systems, and the de-dollarization narrative and safe haven demand. And this is where emerging markets have the most direct exposure, in our opinion. So if you look at what's happening around the world, money is moving around to different places again. And this is just really what it is. We like South Africa. It's got the highest revenue exposure, 22%, heavily linked to precious metals. We like Chile. It provides direct leverage to lithium, and SQM accounting for 15% of the market. Mexico has equity linkages to copper through Grupo Mexico. Indonesia also has revenue exposure to copper, precious metals, and battery raw materials. None of this is financial advice. It's just our opinion. Again, what we think, what markets can benefit from the potential spillovers. Well, in our opinion, we expect the rise of commodity prices to have positive spillovers to other sectors beyond miners. Okay. And again, we believe that this, with the time that it's coming out in the beginning of the year, the spillover has the ability to really change the narrative of how markets are going off. We saw XRP drop, we saw cryptos drop and then recover a little. We saw the crypto market have a net inflow this week. Figure that. Some people are looking at fishing for a bottom. Never try to catch a falling knife, but at certain levels, if the worst is behind in news, and the anticipation of the event, ladies and gentlemen, is always worse than the event. Understand this. I say this all the time. The anticipation of the event is always worse than the event. Once the event is in the rear view, trading, in my opinion, begins to take shape and form again. So we're looking at a lot of things. We're following a lot of things right now in a lot of different countries. Okay, we like Chile, South Africa, Indonesia, and Brazil. We believe that these areas have a lot to take advantage of in the coming commodity supercycle, ladies and gentlemen. That's what we believe. So when you look at supply side constraints, support of the bullish narrative, the demand case for the select commodities that we like, copper, aluminum, precious metals, and battery raw material, is further supported by supply side constraints in these markets. Again, if you look at copper, for example, it's seeing a structurally tight market. We just expect mine supply growth to moderate at the projects. It's just there's not enough mining going on, unfortunately. It's just you need a lot more investment right now is required globally to meet incremental demand and replenish existing mine supply after the current crop of projects ramped up, is that we feel. If you look at aluminum, production is one of the most energy intensive industrial processes. That means that the economies are overwhelmingly determined by energy costs in that market. And in much of the world, rising electric prices have rendered marginal smelting capacities uneconomical. It's bad. So in the medium to long term, we do not expect any major growth. That's just, it's too expensive right now. So when you look at all these things where we're going, what we're talking about, this is fueling the AI. This is fueling everything. This is what you hear downstream from when people talk about what's happening. Again, being the remora, we swim underneath the apex predator. And this is what people are talking about. So now going back to what we also believe were precious metals, global gold mine production has plateaued despite sustained high prices. And there's not really a big pipeline of new large-scale gold discoveries. And that's rough. So there's a decline in exploration, success rates, and geological depletion of easily exposed deposits. There's not a lot to get. Ladies and gentlemen, now taking all this into what I just went through, these metals that the world needs, everything above ground spoken for. And if you're not if you're not looking for these out in raw ground, you got a problem. So the narratives are really, as far as we're concerned, and I spent the last couple of days with a very large family office in South America going over where we see the world going and why. They really wanted to know the rationale about why we saw things coming way before most people did. And at the end of the day, the world has moved away from globalism into regionalism. Now, how does XRP benefit? Ladies and gentlemen, if you made it this far, I salute you. Again, please do like and subscribe to the channel. If you want to understand a lot more about how we go into all these things, please do join the Patreon, okay? Listen, the world's changing. It's breaking into different situations. And when it breaks into different situations, each one of these situations will have themes, players, what they're focusing on, their weaknesses. Identifying all these things, writing them down, having a recce, having a plan is how you take full advantage of the chaos of this. And what I mean by full-blown chaos, China is not going to stop, and the BRICS and the east side of the tranche, they're not going to stop their assault on the treasury and the dollar. That's why they want gold to be an HQL. which it's on its way to being. Again, will that be successful? I don't know. But when you look at XRP, every license they get, every breakthrough that they get, every bank adoption they get, it's in everything. G Treasury, I keep harping on this. In my own opinion, the year and theme of the crypto market this year is utility. Utility. The world is changing. Utility. You see pieces on the chessboard being taken off. You see the commodities that these places have taken off. Now ask yourself this question. These regions that are being taken off, what do they have? What do they hold? Why is it so important? Why is that so important? Ask yourself. Let this marinate in. It's all about commodities. The commodity super cycle is beginning. It's beginning, right? That's why there's a rush for all these things right now. That's why I'm harping on these things today and not overall the ME situation. The ME situation has already happened, okay? Now we got to go to the next ex ante, the next before the situation's going to happen. We have to focus on what's coming next because this theme is already being harvested. So this crop that we planted for alpha, these things that we thought would happen, we're harvesting now. Now we're moving on to the next set of opportunities that we believe in our professional opinion and anything that retains any capacity that can harvest alpha. None of this is financial advice. Again, ladies and gentlemen, people are going to start trying to pick bottoms. That's just what happens. Again, is that a smart thing? That depends on your own situation. But how XRP, see, I had to explain to somebody, you guys might like this. Someone asked me over the weekend, right, how I view XRP to be priced. I said, I can't really give you a figure where I think XRP will be priced at because I derive the future value of XRP from its utility. So when you break up all what XRP is in circulation and you give it to all the banks, okay, and it's placed where it's got to be, when it's transferring from point A to point B, that's what the value is going to be set at. It's not going to be viewed and valued as a regular asset. And this is my professional opinion. Again, that's why I'm hoarding it for myself. Anybody who has any capacity. Again, this is a long-term play. I'm not looking at daily charts. So you're going to get it cut up like sushi. We're going to see when the market opens, the most violent repricings we're going to see. Up, down, left, right. It's going to be full sushi chopping time. Fresh sushi is going to be in the water. There's going to be blood in the streets. Fresh sushi. Now you're going to see money move into certain trades because they're going to chase it right then and there and then come out. But structurally, there's nothing standing in the way from where it's going to go. So as far as I'm concerned, getting back to what I felt about XRP and what was said to me, what was asked of me, it's the future utility of what banks will use talking to each other to move to settlement. And I just can't put a number on that. It's just, I can't. It's too large as far as I'm concerned. And when you look at the play for what it is, what we just went over in this video, that's what I believe this to be at, as far as I'm concerned. That's my professional opinion. None of this is any financial advice. This is just my opinion and it retains any capacity. But having conversations that I have all the time with people, retainers, which I love, the world's going to get smaller and larger at the same time. That's why we are the remora. And that's why I don't care what happens, because there's always going to be the next crazy soap opera of chorus to capitalize off of, to see where the world is going. And to me, that is the true definition of a financial mercenary, being able to prosper from this. Because remember, I told you, got to do this every day. So now the next is rewind what I had said in this video.